Every day, trillions of dollars change hands in the American financial system. If you want to see the exact epicenter of where that global money moves, look right here at the corner of Wall Street and Broadway. And when you look inside those buildings, it looks chaotic. You see flashing tickers, screaming traders, and prices jumping wildly up and down. Either freeze up out of fear and avoid investing their money entirely, or they treat the market like a slot machine, chasing after hyped-up stocks and rumors. Stripping away the screaming and the flashing lights reveals a rational, secure system for building wealth, provided you understand exactly what you are buying. So what are you actually buying? Looking past the ticker symbol, a share of stock is a microscopic piece of a real-world, living business. It makes you a part owner of a company like Costco, Apple, or Amazon. To understand why, look at how companies grow. When a private business needs to build a new factory or invent new technology, they often launch an initial public offering, or IPO. This allows them to raise money by inviting everyday investors to pitch in. In exchange for your cash, that company gives you a share. That share represents your partial ownership of the company's future profits. As the business grows and makes money, the value of your piece grows right along with it. This mechanism funds human innovation, creates jobs, and allows regular people to own a piece of the largest companies on Earth. You don't go knock on Costco's front door to buy that share. Instead, you use a brokerage account, usually an app on your phone, that connects you with a seller on massive digital exchanges, like the NYSE or the New York Stock Exchange, matching your order in milliseconds based on supply and demand. Once you own that share, the price will move. Over months and years, that movement is driven by rational data, company revenue growth, inflation, and macroeconomic decisions made by the Federal Reserve. But on a day-to-day basis, prices bounce around because of human psychology. An unexpected news report drops, and suddenly you see temporary noise. Short-term panic selling creates artificial drops in price that often have nothing to do with the actual financial health of the business. This breathing pattern of the economy creates distinct cycles. You will experience bull markets, where stock prices are broadly rising, and bear markets, where prices drop significantly across the board. These downturns are normal, historical realities of investing. Price volatility is the cost of admission. Selling out of fear during a bear market downturn guarantees a permanent loss, while holding steady separates emotional speculators from rational investors. Even knowing all of this, many beginners still freeze up because they feel intense pressure to pick the right individual stock. They worry that if they choose one company and it goes bankrupt, they lose everything. An index fund, like an S&P 500 ETF, allows you to bypass that risk. Instead of guessing which single company will succeed, you buy a tiny slice of the 500 largest, most profitable U.S. companies all at once: Google, Walmart, Coca-Cola, instantly diversifying your risk. That ownership also leads to passive income through dividends. A dividend is a slice of pure profit that healthy, mature companies pay out directly to their shareholders in cash, simply for owning the stock. While you can take that cash, you can also use dividend reinvestment, or DRIP. This automatically takes those payouts and buys more shares of the stock, putting your money on autopilot so it grows without any extra effort from you. By owning a broad index fund and reinvesting your dividends, you put the collective power of the entire American economy to work for your personal portfolio. Here is the mathematical proof. This chart tracks $500 invested every month into an S&P 500 index fund for 30 years. The flat, straight line represents the total cash you put in. The swooping upward curve represents the final value of your portfolio. That gap filling in between those two lines is the wealth generated purely by time and compound growth. Using dollar-cost averaging, buying consistently every month regardless of what the market is doing, scales ordinary income into a multi-million-dollar retirement nest egg. Time in the market beats timing the market. True wealth is built by starting early, staying consistent, and letting compound growth do the heavy lifting.